Hi, I'm Jasmine.
I'm John. During this video, Jasmine and I will be walking you through some of the most important concepts in finance. Investment returns. What is in an investment return, and how do you identify differences between them? Mastering these concepts will help you understand what you really earned after investing in a particular stock, bond, mutual fund, or other security. Or maybe it'll help you buy that sports car you've always been dreaming of.
Investment returns is a very broad term. In its simplest form, investment returns expresses how much a security or a collection of securities called a portfolio goes up or down over a period of time. Investment returns are also often shown as a percentage change.
There are two main components of a securities investment return: the change in price and earned income.
Let's start by talking about the change in price then. Should your security decrease in value, we call this an unrealized capital loss. If the security goes up in value, this is called an unrealized capital gain. You may also hear people say paper gains or paper losses. These are also unrealized changes in the value of a security.
When you decide to sell a security, you are locking in or realizing the change in value from when you purchased the security. This will lead you to having realized gains, or if the security went down, realized losses. We're always striving for our securities to go up, but it's important to understand that you can lose money when investing too.
Great! That's the first most common element. Almost every security will experience a change in value as people buy and sell at different prices. The other element of an investment return is income earned. Think of income earned as a reward for holding a security.
A reward simply for holding a security? I'm intrigued.
Exactly. Not every security will offer income, but some do. Say you own the stock of a company. Hopefully, that company will generate earnings every year. And if that company earns more cash than it knows what to do with, it might distribute the money to shareholders like you in the form of dividends.
Right. That makes sense. I prefer the extra little bit of safety that fixed income offers me. And the bonds that I own pay me interest income. I also earn that in my savings account, although quite a little bit less than what any bond has paid me.
Income can be very helpful because if your investment goes down in value, that dividend or interest you received would help offset some of that decline, and perhaps even ensure you still earn money. Some people also rely on their income to help pay living expenses.
One important difference is that dividends can fluctuate over time, as a company gets bigger or smaller, while interest earned on a bond is typically a more predictable source of income.
It's also important to consider dividends and interest when you look at investment returns. Returns for a stock or portfolio of stocks that don't pay dividends might show as a price return. Price returns measure how a value of an investment has changed over time without taking into consideration any dividends or interests earned.
Total return, on the other hand, takes price and return and includes any income earned while holding the security.
That's enough about income. Let's talk about time. Time is without a doubt the most important concept in investing. It allows for compounding growth to run wild. Albert Einstein is said to have called compounding growth the eighth wonder of the world.
Whoever said it, it's true. Compounding is an invisible force, and its greatest ally is time. Because of this invisible power, it is important to compare the performance of various securities in a way that accounts for differences in time. Investment returns are often shown in two ways. Cumulative returns illustrates the return experience between 2 points in time. Over long enough periods of time, these numbers can grow to be very, very big. So to simplify things and make returns between different investments comparable, most people will talk about annualized returns. Annualized returns show you the return over a 1-year period, taking into consideration compounding.
Okay, I love math. So if a security grows by 100% cumulatively over 10 years, that's a 10% annualized return, right?
That would be the simple average return. But that doesn't take into consideration the eighth wonder of the world, compounding. The annualized return is actually lower at 7.18%, because each year you're starting from a higher value. So your return doesn't actually have to be as high as 10% each year, because you've earned money on your money in each year.
Okay, Mr. Risk Aversion. I've got this stock whose price has gone up 50% over the last month. What sort of annualized return would that be?
For starters, that is a fantastic return for only 1 month of being invested. Annualizing a period of less than 1 year assumes that recent returns will continue into the future. So we're expecting 11 more months of 50% returns, which is generally unheard of. But if it did happen, your annualized return would be 12,875%, or enough to buy me that sports car I've always been dreaming of.
Wow, that's a pretty great return. And I didn't mention it before, but they are also going to pay me a dividend every 3 months, which I'm planning on reinvesting. That should increase my return further, right?
Yes, you're exactly right. When a dividend is paid, you can take the cash and do whatever you want with it. Or you can reinvest the dividend in more units of that security. If the stock continues to go up, reinvesting your dividend will add to your return as you continue to buy more of the security. But if it starts to go down, your return will be negatively affected by that decision.
Now let's go over a couple of different ways investment returns are calculated: time-weighted return and dollar-weighted return. Time-weighted return is exactly what it sounds like. It's the performance of an investment over a specific period of time, independent of any further investments or sales after your initial purchase. That means it's perfect for comparing different investment options, like Fund A versus Fund B.
Dollar-weighted return, on the other hand, evaluates your personal rate of return, the overall performance of your personal portfolio, by taking into account additional contributions or withdrawals after your initial investment. That's useful for evaluating your personalized rate of return. Let's illustrate this a little bit. Here we have Tom, Jill, and Adam, who all buy the same stock on the same day, but in varying amounts. Despite the security going up and down over the course of the year, if they all hold on to it and do not sell it off completely, they will have the same time-weighted return because they have been invested for the same amount of time. Dollar-weighted returns, on the other hand, are much more specific to each person.
Tom invested all of his money on day one, so his dollar-weighted return is the same as his time-weighted return. Jill and Adam both made transactions. Jill bought the dip because she was able to buy at a lower price than her original investment. We should expect her dollar-weighted return to be greater than time-weighted return.
Adam is on the flip side. He purchased additional shares at a much higher price before the stock declined. As we can see, Jill's smart decision to buy more helped her experience the greatest dollar-weighted return without investing any more money than Tom or Adam did. Don't confuse this with the discussion of cumulative and annualized returns earlier. Regardless of how your return was calculated, it can be expressed in cumulative or annualized terms.
Just to reinforce this point because it's tremendously important, time-weighted return makes it easy to compare returns across multiple investments, or perhaps to compare a specific investment with a benchmark, like the stock or bond market generally, to see how well it has performed compared to a big group of stocks or bonds. Dollar-weighted return is much more specific and personal to you as an investor because it is influenced by a combination of 3 major factors: size, timing, and ongoing transactions like buying or selling.
Investment returns are an important component to understand when investing on your own. We hope that the concepts introduced today will help you look beyond the numbers and have a better understanding of what's really going on, and how you might be able to harness the 8th wonder of the world:
Compounding.